Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. I'm pleased to be joined again by TV's Evan Lucas, a market economist, a behavioural economist, and an economic futurist. We unpack what has already been a pretty extraordinary start to 2006, and we're only a couple of months in. We'll talk about the global backdrop, including the escalating conflict, of course, in Iran, what that means for oil supply, shipping routes, and why energy markets are actually behaving quite irrationally. More importantly, we explore how these shocks could and likely will flow through to inflation here in Australia. From there, we dive into the domestic economy, sticky inflation, the possibility of more interest rate hikes from the RBA, and how consumer behaviour is shifting as people start to accept that higher prices may be here for longer. We also spend quite a bit of time on housing, why property supply is still so constrained, why the government's 1.2 million homes target is looking increasingly difficult to achieve, and the structural challenges facing the construction sector. Finally, we tackle the big political and economic debate that's looming over the May federal budget. Tax reform, negative gearing, capital gains tax, and whether Australia's tax system is starting to distort the economies in ways that policymakers can no longer ignore. It's a wide-ranging conversation about markets, policy, property, and behaviour, and as always with Evan, it's thoughtful, provocative, and guaranteed to get some people thinking. Let's get into it. Here's Evan. Evan Lucas, thanks for joining me back on Geared for Growth.
Mike, it's a pleasure to be back on this program. I cannot wait for us to completely wax lyrical about what has been an extraordinary start to a pretty extraordinary year in 2026. And what are we? We are sitting and recording this on the 12th of March. It's almost like we've had a year's worth of information in 2.5 months.
A lot has happened, and I should have referred to you as TV's Evan Lucas. Obviously, you've burnt a hole in the couch on ABC Breakfast with your economic insights. And what a time to be like an economic futurist and a behavioural economist, because there is like, to pardon the expression, a shit ton going on right now. I mean, of course, we've got the war in Iran. We've got people filling up their wheelie bins with petrol. We've got inflation being sticky. We've got May budget coming up. We've got CGT. We've got negative gearing. I mean, where do we bloody start? How is the economy, maybe, is a good starting point?
Mate, that question is a 2-hour lecture in itself. Okay, first and foremost, let's look at Iran, because I think that is probably what is on everybody's thoughts and unfortunately on everybody's lips with regards to reactions to it. Your wheelie bin comment around petrol is fascinating because it is and does feel like reactions that we saw during the start of COVID with, stockpiling toilet paper and the like. I think the bigger point around it to remind everybody out there is that oil will still come through. Petrol will still come through. Tapas is what we get most of our petrol done. That comes out of Singapore. Singapore has several different avenues with regards to direct oil into it. So we will get it. Yes, the caveat will be higher pricing. There is no doubt that is going to be part and parcel. Getting to back when we're recording, because we actually have to timestamp this considering what's going on. The International Energy Agency's release of 400 million barrels of oil is its largest in its history. Like, that's how much oil they've put into it. Yet the price didn't go down because we're in an irrational period in markets. Like, let's also be honest. We are seeing irrational movement. We are seeing irrational trading. That will therefore lead to price fluctuations that are all over the shot. Does lead to that panic buying of basic numbers. The one I am a little bit more concerned about is diesel. For us here in Australia, diesel, the majority of diesel does come from the Middle East, and that is a bit of a concern because that filters particularly into transportation. I mean, diesel engines are the main source of transportation energy in terms of where we are. So that one is a little bit worrying for me in terms of that space. Again, there will be ways and means around it. The Middle East is not the only supplier. So from that perspective, the behavior is as expected because people always do panic materials. The reaction in markets being irrational is actually as expected because we always get this as well. Just take, the Russian-Ukraine war from 2022 when it started, similar thing. That will filter into short-term price increases in construction. It will filter into short-term increases in materials. You can already see that shipping companies are adding massive reinsurance costs. You can see them also talking about going the long way around, so going through the around the Cape of Good Hope rather than going through the Suez Canal. And although it's the south side of the issue, it doesn't matter. It's pretty close to what's going on. So they may also come into your world with regards to what your listeners and what your viewers worry about. But the behavior is, at this point in the cycle, very stereotypical in terms of what you see in these kinds of wars. Again, you go back to the first Iraq war in 91, you look at the second Iraq war and what happened then. It's pretty standard in terms of what we're seeing.
I suppose what is quite distinctly different is Iran's willingness to engage kind of bystander countries. I think we've got 12 countries that are in the mix in that part of the region, which was a little bit more localized in Iraq. And I suppose the difference to politically is that we're not talking about a Saddam or a Gaddafi. We're talking about sort of an entrenched organization of clerics, of people too, right? So we're having to kind of destroy levels of government to get to a point where we can kind of cut the head off the snake, because there is no head off the snake, right?
Well, that's a good way. I was about to say that's exactly the way I'd put it out. You've got to understand with dictators versus what Iran is, which is a theocracy, and also I would argue a militarial government. I mean, the IGRC, like so the Iranian Revolutionary Guard Corps, is clearly the inverted commas the pseudo government behind where it is. Disbanding a military government is much, much harder than disbanding a family dictatorship or an individual dictatorship. You only have to go through history and see that it is very, very hard. You look at what happened in places like Cambodia with that kind of thing. You look at what happened with Pinochet, etc., and what happened in Chile and all that kind of material. They're much, much more difficult. And that's why, the argument is it will probably have to come from the people in Iran. To how the other catch, and what you're alluding to here is actually a bit broader than just that concept, is there isn't actually an understanding of what the end goal is from the Americans and the Israelis, right? So that's also why the market reactions are so violent, because the understanding about what is the end game / how this ends, as the president keeps using these terms, is undefined. It is technically undefined. And therefore, although it's been suggested that, this is almost over, how that can be true is tough. Getting back to the other part about the regions. So you're right. Iran was always expected to throw haymakers, right? So this had always been the risk in the lead up to this, current conflict, but previously as well. Iran was making it pretty clear that it would go down swinging. And that is why anything with a US connection, so the UAE is a very good case in point. Again, Bahrain, you can look at to some extent Kuwait, not as heavily, but you then even look at what's going on in Saudi Arabia. I mean, that in itself is fascinating, because Saudi Arabia has always been the leader of OPEC. They have always thrown their weight around. They are the largest producer in the OPEC region. They do make up around about 4% of global exports, but inside the OPEC group, they make up around about 27%. So that's a huge thing. For Iran to attack them is also just telling about how big this is and what it means. And as we've seen over particularly the last 7 years, what and how, theaters of war work are different. So drones now are becoming much, much more the thing. And, this argument about missile capabilities, get that. But clearly what we've been seeing in Russia, Ukraine issues, and now also with Iran, cheap couple of $1,000 drones are doing just as much damage as thousands to hundreds of thousands to millions of dollars worth of ballistic missiles. And so the quote at the moment coming out of the US, and some Goldman Sachs has put this out there, there's also been a note from Morgan Stanley that some of the infrastructure damage they've done in the Middle East, particularly the refining in the UAE, could take years to actually bring back online. That for me is a concern, because that supply side will be the determinant of price. And if supply is interrupted for that long, then we are going to see a very interesting price inflection with demand.
And we forget about oil that petroleum products go everywhere. Like I've even heard that they're in nappies, they're in
Yep.
toothpaste
Yep.
somehow. So
Vaseline.
what we're yeah,
It's like, like, so yeah, you're right. Like, so plastics, anything with plastics is a petroleum based product. Pretty much anything you touch has got some form of, for those of you that can't see Mike right now, the glasses on your face have got petroleum products on. Like, so it's like when people sort of talk around things like copper. Copper is, you can't not touch it. It's pretty much in everything that you will have, whether you've got a mobile phone on you, whether you've got, any form of electronics goods, it's going to have copper in it. Plastics are everywhere, and obviously the base of plastics is some form of petroleum or crude based product.
So really, the implication is inflation, right? That's probably what the biggest concern is outside of the humanitarian impacts, right? Is that there's quite a bit coming through the Strait of Hormuz, like that's somewhat kind of shut. It's the US are trying to guarantee the passage, but insurance companies will sting people through the roof for that. The oil supply, I think what we got around about a third of global oil supply comes from the Middle East, and it's the Asian countries that are most reliant on that because the US has its own supply. So I wonder at what point do we see a response from countries like China and India in this conflict?
So India and China have already responded. So India has had its tariffs from the US relaxed to allow it to buy more oil from Russia, of all places. So that's happened in the last week. So already the White House has actually taken pressure off Modi by allowing him to purchase oil from Putin. Think about that statement. Like, that is extraordinary. The interesting one is China, because China at the moment has been very, inverted commas, quiet on this front. It has had two of its major oil nations that it deals with completely disrupted by the Americans in the last 7 to 10 weeks. So it was actually bankrolling Venezuela through basically contra deals with oil. So it was financing infrastructure and other products in Venezuela for actual physical delivery of oil. So this is China's been doing this for a good couple of decades with Venezuela and completely circumnavigating sanctions and all of the rest of it, completely circumnavigating markets in terms of what it is, because Venezuela couldn't get its oil out, really, let's be honest, in terms of what was the sanctions that were on it. And China said, I'll give you a way out, and that is you will give us physical delivery, we will give you infrastructure in response. That's obviously now been disrupted with the fact that they've been replaced with a puppet president. She does allow some form of movement, but overall, that one's interesting. So China will be the one to watch here. Again, they are getting their oil mainly from Russia. Again, they circumnavigate sanctions on what's going on with Ukraine. They are clearly not interested in paying attention to those for obvious reasons. So again, it puts pressure back into other parts of the system anyway. So you then also mean that the pressure that's been going on in Europe with the Russian-Ukrainian war scenario can extend, because Russia is now being financed again by its biggest input. So we're going quite existential here in terms of the global reach. Bring it back to what you originally said before, and let's get back to an Australian-centric point of view. We, therefore, are expecting inflation. So we've actually seen from ANZ and from NAB in the last week that the 6-month rolling average expectations of inflation by Australian consumers is now at 4.7%. So it's currently, as we speak, at 3.8%. That's the headline figure. We expect it to get to 4.7%. ANZ gave you pretty much the same figure. I think it's about 4.65, but it's not on a rolling 6-month average. It doesn't matter. Short answer is the psyche of the Australian consumer is that prices are going to rise quite significantly. The Australian consumer is not only accepting that, but is starting to actually just understand it's part and parcel with life. So this gets back to the RBA's biggest concern from 22 through 24 of inflation psychology getting embedded into us. And it's already started. And it's, that is a big, big issue, and why the discussion coming from the bank is it might not be 2 rate hikes in 2026, which had been originally forecasted. It could be 3, with even the massive risk of a fourth one, which would mean by the end of Christmas this year, for the last 24 months, we're actually 0.25% up on where we were when the rate hike to cut cycle started. So that would be the bigger concern, is that we get baked in inflation from everything we've just discussed, and the RBA this time around isn't as cautious, shall we say. They're much more hawkish and would rather squash inflation quickly, create short-term pain, rather than delaying it like they have previously.
Yeah, and inflation was already proving very, very sticky pre this escalation, right? So now everything's revised upward based on the oil supply shocks. Is that fair to say?
That's fair to say, but it's more than that. Like, even before what's going on in the Middle East and everything we've just discussed, the inflation movement was already there. I mean, we never really saw what you're referring to in sticky inflation. That's sometimes also referred to as the home inflation. So that's like, it's why dentists and hairdressers always raise, right? They're the businesses that stick to their pricing until the very last moment. They try and absorb as much of the cost as they can before they hand it through to clients. So they're always between 4 to 6 months behind the 8 ball with regards to where inflation actually is versus when they actually hand it through. So they delay everything. And that is what we saw at the back end of last year. That transfer was coming through. The other thing that, don't forget, with those 3 rate cuts we had, you can see it. It's automatic. The data from September and October was astounding, because that was the 3rd rate cut now factored in. We got the one in August, and we all got real happy with regards to how we could use the credit card, and off we went in spending, and it didn't stop in terms of what we saw through to Christmas. It hasn't stopped in January either. There were signs that it was slowing down. I mean, we saw the consumption side in GDP. That wasn't good news. That was actually a contraction. Now, some will put that down to the fact that the energy rebate filtered out. It took about 0.2 out of the consumer figure. But at 0.3, it was supposed to be 0.7. That's the consumer is already telling you that they're concerned, but maybe it was the festive season, maybe it was the 3 rate cuts, but we were spending quite heavily at the end of last year. That is clearly now not going to happen, and inflation is moving at such a rate with a productivity in this country that is so constrained that the RBA is clearly worried about that inflation psychology getting baked in. And this time, with a different chair and a different deputy chair, might I point, they clearly have different views about how to deal with it, and they are likely to be much harder than the previous setup.
Yeah, I think Governor Bullock has delivered a number of speeches about the evils of inflation and how it disproportionately impacts the lower subset of socioeconomics, right? So I think she's telegraphed that punch pretty well. And the patience that they've had in the past, you're kind of thinking that's maybe run its course.
Yeah, so Michelle Bullock is fascinating. Her comments that you just alluded to, and you bang on with what she said, she's been saying that for like a decade. Like, she's always been the most hawkish person on the board of the previous board, right? So if you listen to her at Senate estimates under Philip Lowe, she was the one with the strongest opinions around how to tackle inflation. That high inflation is the scourge of cost of living. It is the scourge of living standards. And she's bang on and bang right. She's also therefore been quite strong on her views that you need to nip it in the bud immediately rather than letting it run. Like this slow and steady, trying not to impact full employment. You can, again, I'm probably putting some words in her mouth, but she's always made it pretty clear that she thinks the sacrifice is needed for the longer term sustainability of the overall system. And now she's in charge. Then you listen to Andrew Husser, who's just come in from the Bank of England, who's now the deputy. He's pretty similar in terms of his views. So I think that's the more fascinating aspect of this. And they both have said publicly that the March meeting, which is next Tuesday as you and I record this, is live. And I think that's slightly missed at the moment, that they could actually do 2 rate hikes concurrently in 2 meetings, and it could actually be 3 in a row. They could go, because May is going to get not just the monthly data, it's going to get all the quarterly data coming out at mid to end of April. they're going to be armed to the teeth with data to possibly back themselves to going and reversing all of the rate hikes we saw last year.
What do we expect the impacts to be? Because there are a lot of people will say, okay, well, if interest rates go up, then certainly from the real estate point of view, borrowing capacity will shrink. It should really slow down the price growth. But of course, in the last rate rising cycle, we saw a boom in prices, maybe more about a shortage of listings, but we are, I think, 50% below the 5-year average of listings. So do we need that to kind of turn around before we do see a detraction in the market?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
So there's two answers to that. The first one is I'll do the behavioural one, because what we do know from price corrections in particularly real estate is this is a tangible physical asset that most people that we are alluding to here are living in, right? So investors, will put them to one side, I'll come to them in a minute, but the reason we have such a low supply from secondary listings is if the expectation is the price that we expect is not there, the market isn't going to meet us at the price that we expect, we just withdraw supply. So supply gets sat on. That I actually think is part of what explains the huge drop-off in supply that's happened, particularly in the last 18 months. It's been astonishing to see what's gone on, despite the fact that prices across the country are astonishingly high on the median level. It hasn't actually attracted that supply back in. And there is, again, the behavioural side of it that is arguing the catch with once you take supply out is that it's almost a snowball butterfly effect, because the supply that they would have bought in would have been matched by supply of the housing that they want to get into. Whereas because all supplies of all the way through the percentiles, whether you want to talk about the 5 percentiles or whether you want to talk about, it doesn't matter. They're all down, right? So all of those top, the number one all the way to the 5th percentile, levels, the supplies are really low. So you're getting people sitting on their hands because they don't want to sell the property they have because they don't think they get the price. But the property they would have bought to sell the place that they're in is also not existent, which sort of snowballs out. So that's the behavioural side of it. The second part of it is there is clearly economics at play. So again, Perth, Brisbane, Queensland, WA, let's put them all as a group. There is economics that, definitely is driving that market, right? The jobs growth, the economic growth in those two states and those two cities is quite astronomical. It has attracted a huge amount of migration, not just from overseas. I need to make that very clear. The majority of the migration into those two states is from the other states in the country. And you look at, New South Wales has got still a net negative loss of population. Victoria is dead flat, slightly negative as well. So all of those are the economic factors that can explain why those two are taking off. Sydney's got a similar example. Supply very, very low. Still attraction for services economics explains why we've got a $1.2 million median house estimate in Sydney. So I think even with raising interest rates and falling interest rates, the underlying fundamentals are still there, and you can't stop time, right? So in the last census, which is now getting really old, we're getting a census this year, thankfully, the average first homeowner was 34, and they're not buying a townhouse, they're buying the family home. So they are hitting, a 7-figure house. All of that doesn't slow down. That 34-year-old since, 2021 was the last census. The amount of 34-year-olds that have come into the market over that period of time is about 500,000 people. So all of that together, that demographics, that behavior, and that economics suggests that there could be a shallow correction this time, and it will be shallow if it happens with a rate hike. But all of the traditional, at play pauses in real estate are likely to come through again. And, it might see a maximum 7% decline, but overall, I can't see the property market going backwards because nothing is going to alter demand at this point, even with higher rates.
And I suppose if we go to the other side of the equation in the economics 101 of supply and demand, there's a few different ways to talk about supply. I mean, we're talking about listing supply.
Yep.
There's housing supply in terms of household formation rates, the quintessential little old lady in the 4-bedroom McMansion because she doesn't want to have to, pay stamp duty on the next one. But then there's also construction supply. So the 1.2 million home targets, 240,000 a year. I think with the January approvals data, we could sort of extrapolate on an annual basis. We're talking maybe 178,000, maybe best case. We're about 30% behind, but it actually doesn't seem to be looking any better. Like the trades shortage is not going to be there. Diesel is actually a big component of construction costs, so it's interesting to pick up on your point about that. We've seen diesel spikes in the past feed into construction costs. The pipeline of public infrastructure works over the next 5 years, I think we're talking about $1 trillion. And there's also the big one that I think nobody talks about that's the risk is the natural disasters and that's impact on the construction labour force. So the companies that are engaging people for rectification works are really able to pay quite a lot more than any other industry, perhaps maybe not the public service, but they need to reinstate people back into their homes. It's a cost to put them into hotels or Airbnbs and those sorts of things. We saw bushfires early in the year, but that's always a bit of a concern. So from my perspective, it seems like we haven't delivered on that supply promise. We're about to hit year 3 of the 5. We haven't hit it once. We haven't got anywhere close. But everything I look at tells me it's actually going to get worse.
So my question back to you on that point, because this is your world, is our reliance on importation of construction materials. Do you think that we need to actually start looking more, inverted commas, strategically rather than economically about supplying the construction materials that we need for our housing from this country? Or does it, even with a strategic viewpoint, the economics can actually override that with the cost that comes with it?
Look, I think the last time I looked at it, around about 60% of construction materials are imported. So we don't have a big domestic supply. Like we have things like timber and those sorts of things, but we have too much reliance on importing construction materials. So, of course, when we see freight costs go through the roof or insurance costs for freight, then that kind of feeds through. I feel like we need a lot of innovation. I mean, the AFR shared that story about the $10 billion housing fund delivering 2% of their $40,000 target. I think you got to be careful of just going like that's a terrible failure because they've got to spin up their procurement methodologies and, they've got to get their letterheads and their phone number routed to the right people. So the back end will probably be faster than the front end. But even the government, who you would kind of think doesn't have the same financial problems, it doesn't have maybe the similar labour force or planning or regulation or approvals things, if it can't deliver it, what chance does the private sector have to do it? So I think we need a lot more construction innovation. Like you were talking about productivity, I think we're running at about 2% productivity across all industries and construction's about 0.4%. But construction's quite disparate as well. Like it's a lot of subcontractors. There aren't these, there's big unions that have been in the press, but it's subcontractors sort of dotted around the country. It's not an industry that you can force kind of innovation on really, really easily. But I do think we need R&D incentives and anything that reduces the time to construct, because that's where the cost escalations really seem to be.
Yeah, so on that, do we also need to look at what we allow from a regulatory basis and also from a sort of an acceptance basis, construction product? So, prefab, pre-laminated material is massive in Europe and overseas. It's obviously very quick, comes together and they can construct housing quite like a Meccano set. Even as going to as simplistic as some people are trying to push, turning existing materials into housing materials, shipping containers, case in point. Is this part of the answer? Is that what we think we need to be looking at? Is that if we are going to go down to, particularly public housing, social housing, that we need to reach that the actual materials obviously still need to meet all the thermal regulations and all that stuff, putting that to one side. Is that, in your view, part of the way that we can address, inverted commas, construction productivity? Because the speed at which you construct those things, is massive. The last data I looked at was quite fascinating was, the time for completion for high-rise buildings went from 33 months down to 31. It was championed, and a freestanding home went from 13 months down to 11 months. But if you look 10 years ago, those two things were like 20 months and 9 months.
Yeah, the dwellings constructed per labour hour, I think, has not improved really since the 70s. I actually had a little bit of a fight with the New South Wales Housing or Building Commissioner because I didn't actually even make a comment. I just said, here is the latest Australian Institute of Quantity Surveyors, construction costs and time frame. And he basically had to go at quantity surveyors for the time it takes to build something not ever really going down in history. But of course, there's little things like deaths on site have plummeted, right? So we've got safe work method statements. So you do have to think about all of those things. But if you think about the big problems we've got, it's timing and it's labour. Now, timing is regulations and approvals and those sorts of things. Like Alan Kohler shared on ABC, you might have seen the number of town planners to the dwellings approved. Like town planners have grown quite exponentially over the years, but the number of dwellings approved per town planner hasn't changed. And I don't think that's because town planners have become lazier or less competent. I just think there's too much regulation. That's one thing. But if we talk about labour and timing from a construction cost, the prefab and the modular stuff attacks the jugular of those two things. You need less people. It takes a hell of a lot less time. It might not necessarily be a panacea. And we've got a fairly big country. Maybe these models work more in Europe, but we're just so far behind in a lot of ways. I think one of the big impediments is financing, right? The banks don't necessarily know how to lend to it. Like during COVID, we saw banks guarantee deposits, right? But the government could step in and say, like, these types of construction methodologies, we will back the banks if they're lending to these sorts of things. Like, that's where I want to throw it back to you. Like, you understand those machinations, but if we can take ideas like these, how do we actually get that into the mainstream and start building it?
Yeah, so the caveat straight away is the Banking Royal Commission, because what we have seen around lending and the way that lending has worked in the post-Banking Royal Commission spaces, we've always been very lucky. Our financial system is incredibly secure. It is really, really risk-averse. It's very, very stable and very sustainable because we do have banks that are, in the main, actually quite conservative in terms of how they lend. We don't have the issues around what we saw in the GFC with the US where, lending was basically the Wild West. Lending standards were pretty there, but we've always had very strong standards and they've only got stronger, which most people argue is to our benefit. Again, over leveraging, gearing people is fraught with danger. We know that even so, we're starting to see it creep up to those that would love to point out, income to borrow ratios are getting 6, possibly up to 8 times income, et cetera, et cetera. But I think you're right. I mean, we're happy to fund green initiative projects, right? Very easily with really, really government-backed next to nothing interest rates in terms of that space. That is part of the out-of-the-box thinking that needs to happen if they want to achieve their 1.2 million homes. I mean, let's be honest, it's not going to happen. But if they wanted to go down and rapidly ramp it up, that would be part of it. Is to, instead of doing the first homeowners guarantee system and, hyperflexing the demand side, how about you hyperflex the supply side by going, we are going to start allowing, already innovated ideas to supercharge the housing construction. And the lending can therefore be backed for it. Again, you will get cowboys. There will be issues. The current government has got issues like the pink bat scheme, in the back of their heads and being burnt by that. Excuse the pun. That's the caveat with it. But from a pure finance perspective, the banks will not touch it because it has risk behind it. It doesn't meet all of the metrics that they now have to tick. And again, they make much, much more money from secondary housing refinancing and secondary housing lending than they do around primary. And so, again, this is the caveat with the system: is it is geared, excuse the pun again, to the tradition rather than doing the new, and therefore the reaction in my world, the behavior will be that is what we know, this is what we do. We are not changing because we don't have to. There's no incentive to change.
However, I think the incentive is coming from young people, especially when they're looking at, okay, well, in the 1970s, the income to asset price ratio was maybe 3-4x. Now, a bit like lending, it's 6, 7, 8, 9x in certain locations. And the government's response so far is to say, well, it's mostly property investors' fault. Now, I know that you're pro CGT reform. You've commented that you believe there needs to be some intervention in and around things like negative gearing.
Yep.
I'm not necessarily going to argue, but I always want to put a caveat. I want to put the caveat to firstly say it's too convenient, too easy to just blame property investors on house prices. I think the first port of call is the failure of that 1.2 million homes and the failure to deliver any legislation or new policy that encourages speed to market for construction. But if we park that to the side, let's talk about that big elephant in the room and what could be a really fruity May budget.
It's going to be a hugely fruity May budget. And so I put my cards on the table why so if you had to ask me this question 2015 up to 2020, I was pretty heavy against it. There was no reason to be changing it. It was working. The way that it was working also was leading to better natural wealth outcomes into the future. However, like with all things, if you incentivize certain things, that will be the outcome. So the incentive to use leverage, because this is what I think sometimes lost in property. A mortgage is leverage, it's gearing, right? So the hundreds of thousands of dollars that people make in property investing is because of leverage. You can do that in anything. The difference also with property to the rest of other markets, bonds, equities, cash, take your pick with regards to investment markets. It's the only one unregulated. There is no headmaster. There's no ASIC. There's no AFCA. There is no overseer with regards to rules and regulations around what you can and can't do. It is literally choose your own adventure. Now, that might be a bit aggressive, but it needs to be said. So you can have people coming out there on any medium they want, including like what you and I are doing right now, promoting investment material opportunities that actually involves negative gearing, that involves, basically harvesting capital gains tax. I mean, if you hold an investment for 1 year, half of the profit is yours to keep tax-free. That's pretty astounding in terms of what it is. That's the way to look at it. Okay, yes, it gets halved from what it is, whether the full amount down to the half amount, but it doesn't matter. It's incentivizing, A, short-termism, B, it also incentivizes you to gear up to a point that actually is capital positive but income negative. That's a risk. You are therefore also distorting and retarding supply again in terms of what you're offering to. So the changes come. And as I said, I was against this until probably about 2 or 3 years ago. The changes has to happen. It needs to go to it. The word here isn't fairness, and I can understand people getting really angry at me for saying this. You are still going to make hundreds of thousands of dollars, right, in terms of this space. What it's trying to do is stopping the incentive to make your income, your personal income, much more unattractive versus passive income, because that's where it is, right? The incentive to work, the incentive to actually drive to perform better is retarded by this. That's you don't need to work harder because I promote this in terms of what I do with regards to wealth management, financial autonomy, the whole bit. Passive income is absolutely what you should be doing. It should be driving the way you do it, gives you more financial freedom, etc. But it's now got to a point where it actually is impacting productivity because it's stopping you from investing in yourself, from working. And if people don't work, we don't drive product forward. right? So because the biggest issue, stepping right back, negative gearing and capital gains tax is a part of the whole tax problem that we have. And personal income taxation in this country is too high. Having a 45% tax bracket for the top tax earner, I'm not defending high wealth individuals, but 190,000 versus the rest of the world is not that big, right?
No,
it's
not anymore.
That big. Not anymore, right? So what's the incentive to work to get smaller, right? The fact that it's not indexed, the fact that it doesn't work through. So you are driving behavior to do these kinds of programs, to chase negative gearing, to bring myself below 190, to even try and bring myself below 130, right? 37 cents in the dollar, that's extraordinary amount. That's what the top tax bracket should be, not the second from top. You then also are driving a risk into the system, chasing lower tax returns. Government misses out, therefore it looks stupid. You have unproductive assets being the most invested in assets. It's a whole quagmire of problem. So again, the reason I think you need to get away from this, and CGT as well, is that you will actually force capital back into more productive assets. Now, housing is still a very good asset, don't get me wrong, but if you look at it purely economically, it doesn't produce anything. You might argue it produces children, but that's about the only thing that housing produces in terms of what it is. It would therefore increase owner occupancy. It would allow for the ability to look at work in a more positive light and actually get the aspiration that we need back, that if I do move up the pay scales and I do therefore move up the tax brackets, it's not going to be to my detriment. So I look at it from a bigger perspective. We need to get back to the idea of driving people to work and actually get ahead by working rather than taking vehicles. It's not just negative gearing, it's not just capital gains, this is trust as well. All of these other avenues that the tax system has incentivized us to do has now got to a point that it's actually impacting the overall economy to the downside.
I suppose devil's advocate would say, okay, well, sure, if we come to the agreement that we need reform because we're incentivizing and you know, there's people saying, show me the incentive, I'll show you the behavior. It's like the Freakonomics kind of stuff, right? But at a point where we haven't had the latest vacancy rates, as far as I'm aware, but we're like hovering around that 1.3% vacancy rate. I think there is this idea, if we disincentivize property investment, we take a property investor out and a first home buyer takes their place. But people do have to save for a deposit. And I think over the long term, around a third of people always rent because they might be new migrants, or they might be only living there for work, or they might be on some sort of disability support pension or short-term contracts, and they just don't look good for the bank. Yep. Is it a risk that we see, you know,
in renting?
Yeah, and we've really just gone through 3 or 4 years of insane rental growth off a base of basically not outperforming inflation. So can we stomach another bull run on rents if we have a drop in supply?
Yeah, so again, the other side of what we saw is, let's take Victoria as the example, right? So I do not support what the Victorian government has done. It has actually made things very, very unattractive, so much so that it's actually now, again, slightly retarded the market. But if you look at the changes that they took into 2024, and I was pretty negative on it and still am, the actual outcome has been surprising, which is that it hasn't seen a surge in rental material increases, despite the fact that we had a massive run-on in investors selling their properties back into the market. They actually wrapped up supply and got out of it. We didn't see a run-on in rent in Victoria. And there's an argument that this would be the same, right, in terms of the actual impact on rental causing it, because your level of rental supply would fall because you've got more properties coming back on. Again, if you look at the data that you alluded to before around the composition of the home, we are starting to see that there is now a move back up from the low that we got at the end of 2023-24, where the average homeowner, the home size was 2.4 people. It's now getting back up to 2.6. In the capital cities, it's 2.8. It's getting back towards 3. So the catch that originally was put on that argument is that for every homeowner buyer, you would have lost about 0.8 of a renter. What I mean by that is that renters were having 2 to 3 people, whereas homeowners were getting 1.5 to 2 people per household. So there was more renters getting back into the market. This time around, with again using the Victorian data, it's not happening that way. So the renters that would have gone into that home are actually going into the homeowner pockets. Yes, I get your point around the ability to borrow for a deposit. Yes, I get your idea around those that are coming in. That still will be the case. But there are enough people that have been renting for between 2 and 10 years that have the deposit ready to go. They just cannot get the house property that they want. And this might force that out, right? So this might actually see those investors de-investing to get through it. Because the other question that I'm sure you're going to ask, and I'm going to say it as well, do you grandfather or not grandfather this?
Well, the Grattan Institute have said categorically that they don't recommend grandfathering at all, but that's typically the way that we've done things.
Yeah, it's a bad idea, right? So again, the whole idea of this May budget that we're hearing is about addressing the inequalities of intergenerational wealth. Now, for good reason, investors are going to kick and scream, and they should kick and scream and make a lot of loud noise about it. But it just again shows that the inequality gets passed through, because it means that anybody starting their investment journey today is completely disadvantaged from those that have had time with the old rules and the old system. And it again won't actually move the dial. So politically, it's going to hurt. I'm not going to argue that. And I don't normally agree with the Grattan Institute, because I think some of the things they say is just so simplistic in terms of its space. But even E61 has also made it pretty clear that grandfathering is not the way forward. Ken Henry has also come out and said grandfathering, he absolutely despises it and should not be entered into in any shape or form. The other thing that he made clear, and I agree with him to some extent as well, is that it shouldn't just be property that this is moved to. This needs to move to all investing, despite the fact that that will disadvantage me. I need to point that out very clearly. I am invested in all forms of asset classes. This debate has finally got to a head where, and I remember sitting, I think I said this to you last time I was on here, is that sooner or later the government is going to be dragged kicking and screaming to tax reform rather than actually engaging in it. And it's coming faster than they realize. It's here. This is the moment that I was waiting for, which was they are now realizing they cannot keep postponing this, hiding behind political literature and ideas that we haven't taken to the people, blah, blah, blah. We cannot, as a country, continue going down the current avenue that we have, because it is now so structurally out of whack that it is impacting everything we do. And property is not the only area that's going to get hit by this. It needs to be made very clear. What we are talking about here is changing the scenario between production and productive assets, aka us working, versus passive production, which doesn't have the same impact. It's going to suck. It's going to hurt. It hurts me. It hurts you and everybody out there listening. But if you look at it from a holistic point of view, it makes complete sense.
So in the time that we've got left, what is your expectation for what we will see in the Mail budget? So it does sort of seem like it's a guarantee that we'll see some CGT reform, negative gearing, quite possibly. What else can we expect?
Yeah, I think so. I think it's both of those things. I think you'll actually see it spread through all forms of passive asset capital investment product, right? So I think the best way I can answer this question, and I probably should have started with it, is that one of my biggest bugbears that I love putting out there is something I refer to as the chart. It's part 3 of the budget. It's chart number 6, if off the top of my head, which is the percentage total revenue of the federal government of Australia. And it shows the breakdowns of all the taxation streams that it has. It's forecasted that 62% of all of its revenue will come from personal income tax in 2026-27, raising to 63 in 27-28. If you include business and company tax, that's 75% of their total tax take. Then everything else is between. Superannuation, tobacco, fuel excise, those two together. And then things like, income.
Royalties and...
Yeah. If you're an asset manager, that's a massive problem. That 62% of your revenue comes from one stream and 75 from two, right? That's a problem. So the Greens this week have obviously gone through with the $3 million superannuation tax changes. It's a terrible policy because it doesn't actually capture enough what it should do. superannuation should fall under the same sort of bracket system that personal income tax does, with a discount, right? It can't be at the same levels. It has to be, 5, 10, 15, maybe maximum 20. It's a 25%. We are one of only 3 nations on the planet that doesn't tax pension phase. Think about that. That means you can also claim back franking credits. Think about that. Like, companies have paid the government the 30%, but because it's your income, like, this is how complex the system is. So all of why I'm saying this is that there will be personal income tax reform. It will see some form of change. Now, a centre-left party is never going to look at the top tax bracket and change it, because that's just not in their remit. But they are very aware that they are, having to chase that, because, there is now 20% of the population that earns over $120,000. The median income in this country is now $105,000, right? So 190 is not that far away in terms of where it is. So personal income tax will be one of them. Negative gearing, capital gains tax will be the other 2. And there will probably be some form of reform around asset taxation, because there has to be. Again, everything that people have been doing over the last 20, 30 years has been towards this side, and all of a sudden the rules are going to change and people are going to kick and scream. That's fine. You should kick and scream. But if you actually sit back and look at the longer whole, if your personal income tax is better and you can have more money in your pocket now for working, can actually get ahead now for working, the government will argue that's a positive. You can still put it into superannuation and still get the tax benefits that will come from that. They just won't be as generous. Those of you that are retired need to understand that you are going to have to start paying tax, because somebody earning money today at 22 will pay more tax than any generation in its history. And for me, I know you've got kids as well, Mike, like, that is my biggest concern, is that my 2 daughters will pay more tax than I ever paid. And I know that I will pay more tax than my parents ever paid. And my parents had the biggest boom period in history of all generations that have ever come before. And I don't want my kids to miss out on that, because a tax mix is incentivizing me today rather than incentivizing the future.
That's a very good point.
Mate,
that's actually a fantastic way to finish. I think, mate. You've been speaker one for the affirmative for the case for tax reform, and it's really, really hard to argue that, because
yes, it is.
I mean, we talk
particularly
about
to your audience, which are property investors and property people. Sorry to interrupt you, but I've actually said to you, I've changed, because once upon a time I was very strong on the idea this wasn't the idea. It's not about that anymore. The reason I have to make that argument very clearly is that the mix is wrong, and that's the catch. The mix is wrong, and we need to fix it now. Take the Band-Aid and realize that for the longer term future of not just ourselves but our children and our grandchildren, need this to happen.
And we'll get some housing supply, hopefully, at the same time. But anyway, send your hate mail to Evan Lucas at News Breakfast.
Yeah, send your hate mail to evan@evanlucas.com.au. I'll be waiting for it.
Beautiful. Well, mate, it's always a pleasure to have you on. You're a very, very deep thinker and a passionate man in and around everything that impacts the behaviours that we make, with the influence that we have on top of us. And I always get a huge amount out of you, and love to chat to you in the wake of the May budget as well.
Mate, I love being on here. I love having this discussion with you. You are a fantastic voice for your industry, and thank you as always for having me on.
Thank you, sir. See you next time.